So the Federal Reserve cut interest rates by 0.25%, but mortgage rates went higher. How does that work? Well, as I've been talking about the last few weeks, we all knew the Fed was going to cut 0.25% in their September meeting, and they did exactly that. So there was no surprise to the market. The mortgage market already priced that in. What the mortgage market was looking at was, does the Fed have a future outlook of more rate cuts to come over the next few months or years? And they did. More Fed members shifted towards wanting more rate cuts this year. The kind of consensus is they're thinking 2 more rate cuts in 2025 alone. So when that came out, midday yesterday, the mortgage market started picking up some steam. It looks like we're going to get better, positive, better rates, better repricing. But within the half hour, before the mortgage market could actually fully, see that through, the Federal Reserve Chairman Jerome Powell spoke and pretty much just took a very neutral stance on it all, saying that, hey, we're still going to take it meeting by meeting. We're going to watch the data. Doesn't mean we're going to have future rate cuts. He kind of pulled back every bit of positive momentum, and that actually hurt mortgage rates. Mortgage rates finished the day a bit worse yesterday because of that. That's what I've been telling people. We don't want to wait till the Fed talks because we know they're going to cut rates. You're already getting those savings 2 weeks ago. There's no sense in waiting because it could be very volatile. So we advised everybody, we had our whole pipeline locked in beforehand, just for protection, knowing that, hey, if it gets better, we can still lock you in with a better rate. That's the unique advantage that we have. Most banks and lenders lock you in once. So ultimately, Jerome Powell said he's going to go off the data. The interesting thing there, I think kind of the elephant in the room, is the data hasn't been super reliable. Even at its best, it's a very big lag. A lot of the data is a 12-month rolling average. So they're looking at what happened last fall to make decisions on this fall. And even when they cut rates this fall, it's not going to really impact the day-to-day lives until this winter. So it's like a 1.5 year lag sometimes before it really sees a benefit. And 2, the data hasn't been super accurate. They just stated that they overstated jobs by over 900,000 jobs in the last year that the data says were created, and they recently found out they were not created. So we've been looking at the whole wrong data the whole time. I've kind of been calling it out in a lot of videos. It's interesting to see that it actually came through to fruition. I've had multiple videos about there's cracks in the economy that just haven't been revealed yet technically on the data, but I think we all can see them in our day-to-day lives, that the workforce, unemployment, inflation, it's not so perfect. And the Fed has kind of had the thought process that it was pretty perfect. So interesting stuff going on right now. Right now, mortgage rates, though, very volatile. The best thing you can do is get protected. Still, if you bought a house in 2023 or 2024, it is worth looking at because there could be some good savings. We've had literally dozens of families in the last 7 to 10 days that have saved a few $100s a month in their mortgage payment. So there is big savings there. Reach out because it's very volatile times, but I think good times are coming.